Hello, everyone, and welcome to The Buck Stops Here. I am Catherine Murray. Well, today we have an old colleague and friend joining me. Tim Gramatovich is joining us. We've been speaking on television now for about 15 years, Tim, and you have a new position. You are a principal at Invesco Credit Partners. So I can't wait to hear all about it. And I think also interestingly for our viewers to know, you actually started in fixed income back in the day under Michael Milken at Drexel Burnham, who he had created the junk bond market. So uh, look at you. You should be smiling more. What a history you've got.
Look at us. That just all you said is how old I am. Yeah, in terms of that stuff. So I was it. And Jeff had started with me earlier before we jumped on together and said, Tim, you have a voice for radio. And I said, well, Jeff, actually, they told me I have a face for radio. So, he got that wrong.
So two great compliments and within your first couple of minutes dealing with our producer and then me. But I mean, look at your history.
We're family. We treat each other with the truth, right? It's like that. We're good.
Yeah, exactly. So why don't you maybe just give us a little bit of your background? I just think that, people should understand how powerful Drexel Burnham and Michael Milken has been in the industry. Like for you to have worked with him and grown up with him would have been kind of pretty interesting.
Yeah, Kevin, it was, back, I mean, I was there pretty much at the beginning. It was really, you're talking about 1985, right? So, I mean, I think the firm was like, we had 600 or 700 employees back then. And then ultimately in the next 5 years, I think we ended up with 10,000. So, I mean, the long and short of it, the premise was simple and brilliant, right? It was like at the time, if you had a, non-investment grade rating or junk ratings, that simply is below triple B minus, you couldn't access the bond market. You couldn't access real money. And, our approach and Mike's approach was basically, look, at the end of the day, there's an opportunity here because you have new industries, new businesses that require a great deal of capital. Actually, just recently, I guess a couple of weeks ago, Ted Turner had passed away, which was sort of a very interesting thing for me because Turner was obviously one of the first and biggest clients of the junk bond machine, right? Because they were looking at creating CNN and TNT, and then the infrastructure for all of the entertainment space, and then of course we followed that on with telco, cable. I mean, very large packages that again were all relatively new companies that needed large amounts of capital. So you had two choices: the equity market, very expensive, or the bank market. And the bank market was back then was like the Canadian market is. It's like you give me $1 million and I'll give you $500,000 of your own money back, right? So it's like there was no purpose to it. So yeah, it changed the world, right? And then we slid into obviously the deal business and the LPO business, et cetera. But without a doubt, I mean, it was a mechanism. And then in 1990, when we ultimately failed, I did a year of work with the U.S. trustee in the federal bankruptcy courts, understanding how to restructure all of it as well. So good, again, good training ground for sure. You can't replicate that.
No, and it's still so famous for so many reasons. And as you say, many of these industries really needed access to capital that wasn't being provided because they weren't rated as a AAA. And yet, look at where we would have been if they didn't have access to that capital.
Crazy. Well, and to your point, Catherine, to your point about the name recognition and other things, because when obviously Milken did some time in terms of that stuff, they needed a scapegoat, et cetera. When he came out and formed the Institute, I did a little bit of work with the Institute as well in terms of speaking, et cetera. But now I understand that there's about to be a Milken Institute conference in Toronto. I believe that they just set that up because the Institute conference in LA just happened a few weeks back. And I know that they've announced something in Toronto now. So yeah, no, it's again, smart folks without a doubt, in that regard. And definitely an interesting group. Little did we know, first we couldn't get jobs, then we controlled the world. So, you never know.
You never know. It's cycles. And to fast forward, we've got 20 seconds left in the segment, but to fast forward, we look at the fixed income market now and it's gone through a lot of changes. I mean, I even think from an investor perspective over the past number of years, a lot of investors said, we don't really have an interest in having fixed income in our portfolio. Your firm is changing that. You think that there's a new strategy to employ.
Yeah, that's a really good point. And I mean, fixed income, and that's a very broad term, obviously, but I mean, a bond market, structured credit. I mean, there's so many things with inside. We'll pick it up, but has typically been the purview of institutions, right? Insurance companies, banks, very large investors, and individuals need to understand that market.
All right, quick break. We'll be right back. Tim, it's interesting when you just mentioned that the fixed income market, which, as you said, is very broad, has really geared itself towards institutional investors, not retail clients or small family offices or even large family offices. Can you describe why that is? And I think it's also really important for people to understand how much larger the fixed income market is versus the equity market. In other words, maybe you're missing out
Yeah,
or not.
good point. It's a valid. I mean, again, the bond. I mean, what was the statement? It's like the guy, Clinton's old advisor said that he goes, well, when I believed in reincarnation, I wanted to come back as a baseball player who could hit 400 or the president. And he goes, now I just want to come back as the bond market because it intimidates everybody, right? It was James Carville. And so, the bond market runs the world, right? I mean, and that's for most people, the bond market includes, government bonds, right? So treasuries, that includes agencies, and then you can broaden that out, and there are mortgages. I mean, people don't understand every single product, whether it's a credit card receivable, an auto lease, et cetera, ends up in a fixed income product, right? We call it securitizations. But people have you're looking at a time in the cycle today, and you and I have been around for a while, and I started really, I guess 40 odd years ago was the beginning of kind of the rate peaking. I mean, it peaked about a year or two before I started working. I think where were we 18%? And by the way, you couldn't give away double tax-free munis in California where I was working at 15% because people thought rates were going to 20. It's insane, right? I mean, today we would go through this, but we've watched rates come down for, I don't know, 35, 40 years. And we had that the zero income, zero interest rate policy for a number of years after the crisis of 08, 09. But you're kind of looking today and you're saying, I mean, you and I are watching the same stuff. We were veterans here, and it's like, this is the most dangerous equity market that I've ever seen in my career. I mean, both valuation hype, it's the everything bubble, right? In that regard. So it's like, all right, where do you go? What do you do today? And the challenges in fixed income are pretty significant as well, right? Because one of the things that we're working on, as an overlay, let's frame it so people can understand this. We call it the OECD, but it's just developed countries, rich countries, and everybody's got the same playbook. Nobody gives a rip about balancing a budget, worrying about any of this stuff. Before, people used to government used to lie to us, right? We're going to balance a budget in 2035 or 2037 or whatever. They're not lying to us anymore, right? This is like, we're going to spend, and here's the deficits for the next 5 years, and that includes everybody. Canada's the same, US is the same, et cetera. And so you have some challenges because, I mean, that's an overlay. And so you've got pulls on rates going the other way, right? And that is that you've got, the technicals are not great. When I talk to insurance companies and real money buyers of this stuff, there's no real bid for anything over 5 years in the bond market, right? And that includes most structures, high grade stuff, from treasuries to mortgages to munis, et cetera. Because everybody's very worried about duration or rate sensitivity, and rightfully so. You've got people are focused a little bit on inflation now, right? We've got the oil price thing, we've got a number of other things going on, but I think you have to also understand just the destruction of paper value or fiat currency, right? Because if you're just printing all the time, supply demand, right? I mean, at the end of the day, you've got too much supply, not enough demand, and rates are going up. And I think this is the market now that nobody has seen, right? It's like, okay, I saw a smidge of it, but most of my career has been going down. Now what, right? I mean, that's really one of the challenges, because you're looking at it going, okay, you can buy into the equity market, and I mean, good God, every day there's another $1 trillion company, right? Was Micron yesterday or whatever? It's like, right? I mean, $1 trillion. I mean, like it's nothing. It's the size of countries now. So I look at it going, all right, how do you protect yourself? How are you going to maintain purchasing power in what really is an increasingly nasty inflation market? It's embedded. It's not the Iranian war. It's like we talked about before. It's every commodity, because paper currency is going down in value. And of course, we have, Catherine, our favorite topic of the trade game, right? In terms of what's going on with tariffs and trade and American trade policy, right? And I will say something. And there's a fellow in put an op-ed. This was a number probably about a year ago, and he mentioned something from he was a Canadian perspective, and he said something that I think is pretty accurate that I don't think people understand. And he said that everybody thinks this is Trump, right? Saying, okay, Trump is setting these policies, and these policies are in because Trump is the president, and when he's no longer the president, it's going to change. That's not true, okay? And what's happening is policy-wise, America has kind of changed its game, right? The pie isn't growing as fast. And so this is bigger than him. And I think that that's something that's here to stay and is potentially getting worse, from that perspective. So these are all negative drags on rates.
Absolutely. We'll take a quick break. We'll be right back. Tim, just to be clear for our viewers, when you say all of these taken together are negative on rates, you mean they're negative as it relates to inflation going higher. Rates are going higher. And we're seeing that. And it is so interesting that, when you have the US 10-year yield above 4.5%, that it hasn't really shaken the equity market as of yet. But you do seem to have real concerns about that. And you're making the case against stocks with this new fund that you have. So talk to us a little bit about that.
Yeah, well, again, the notion to say that, great, I'm agnostic. I'm an investor. You're an investor, right? We're pretty agnostic. We're just looking at the markets. The data, historical data, says to you and I, and to all investors, that if you basically start to look at allocated equities in here, you're guaranteed to lose money in the next 10 years. That's what history's told us, right? There hasn't been a single exception. Also, another point that needs to be understood is that we in the US have cut rates, 100 basis points. And for the first time in history, rates have gone up, right? In terms of, you mentioned the 10-year, when you started to look at where they started cutting those rates, rates have gone up over 100 basis points, right? In that regard. So it's a very odd market. And so you're looking at this going, all right, I'm, like I said, valuation for me, do I believe in mean reversion? And simply saying, does history matter on these things? And the answer is, to me, it does, right? I mean, you're saying maybe it's different and, whatever, maybe, but history says it isn't. And so now you're stuck, right? I've got everything going up in price, from my groceries to my gasoline, to my housing, to my insurance, et cetera. And how do I protect capital at the same time? So what we looked at is to say, all right, it's inside the fixed income universe. Where can you go, right? And for me, it was interesting because you mentioned the background, high yield bonds, right? Bonds are fixed rate coupon, right? It's like, okay, I have a 9%, an 8%, a 7% coupon. One of the arbitrages, or one of the things that we were able to, take advantage of through I was going to say through the years, God, that's over, through the decades, is that this, what I would refer to as a size arbitrage or a ratings arbitrage. And what I mean by that is that ratings historically have favored, it's not historically, the models favor large companies. And so smaller companies are punished from a credit ratings perspective. So you could have great numbers, great credit metrics, wonderful business, but if you're 900 million versus $1.5 billion, you're going to be punished from a couple notches of lower rating. So you can do some work there. The problem, or the challenge, and now the opportunity, is that market has gone from the bond market into what we call the loan market. Now, let's distinguish the loan market, because this is not private credit. This is not direct lending. This is the hot topic du jour, right, over the last, year. What we're talking about is the public institutional term loan market, which is very large, about at 1.7 trillion. And it's public. The market is rated, in terms of stuff. So it's like, this is a very different market. This is liquid. This is transparent. Banks and dealers make markets, et cetera. So, that market to us is incredibly attractive, right? From a spread perspective, it's average. It's not, I'm not going to sit here and say, oh my God, the spreads are fabulous. They're average. But what it is they're floating rate, which means that if rates go up, you're protected, right? So it's a very, we call it very low duration asset, because that's a good thing if we believe rates are sticky or going higher, which I do. Yeah, I certainly do. And so we have a bit of protection there. And then also just the ability to have a, again, transparent, diverse portfolio. And so you think about it going, what you're doing is, even in LPGP structure, which we run, which is available to accredited investors in Canada, will be in the US shortly. From our perspective, what we do is we build that loan portfolio, and we have a partnership with the Bank of Montreal that allows us to put a little financing against that, right? So we have very, very low cost of capital to increase our yields a bit.
To leverage up a bit,
Yeah.
right?
I mean, if you
Yeah.
look at the data, I mean, if you look at what we're allowed to do versus what we would do and what we are doing, it's half. So let's say that we could go 5-1 in that leverage, in terms of 20% equity. We're nowhere near. You're going to go 2 or 2.5-1. That's not the way we would operate. But the cost of capital is very attractive. So all of a sudden now you're generating an upper single digit number, a 9 or a 10 handle on a portfolio that is risked and has the risk metrics that are less than half of the equities, right? Because first, you're a first lien loan holder. So just your prioritization on the capital stack, you're at the top. And then secondly, it's a low volatility asset class, right? Because of its floating rate nature, it doesn't bounce around all
Right.
over the place. So it's relatively stable. So I mean, that's our solution. We like it. We wanted to create something that we were wanting to invest in. And for us, that's what we feel comfortable in, certainly in this market today. And who knows? We'll see what happens in the equity game, but I'm worried.
Okay, we'll take a break. So Tim, interesting asset class or product that you're creating or is already there that you're building a fund around. So a couple questions. One, when we think of that corporate loan portfolio, to me, the way you've described it, it sounds as though it's maybe more mid cap versus large cap when we think about equities. Number one. Is that fair to say?
It's a really interesting point, Catherine, because when I started this, let's go back even the loan market 15 years ago, our average position size when we said small was about a $300 million tranche size in loans. Today, that's closer to 600 or 700 million. So yeah, is that considered a mid cap? It's considered a small loan today, by the way. Yeah, so you're probably right in the scheme of things, but it's not that small.
Right, right. But relative to the AAA rated or what you're describing
That's right.
and why there's an opportunity. And then when we think about having first lien, because you mentioned that as well, that is obviously the best that you can get, I believe, in fixed income first lien. But at the end of the day, Tim, we're still depending on corporations that will do well, that will pay back that loan. And you're collecting the coupon, meanwhile, as you wait for your capital to be returned, which is also what you're saying about this product. You want this is so interesting and really important. I feel so many people are more focused on this. Not nearly enough, if it's the 1 or 2%. I want return of my capital, not return on my capital. I can't eat return on. I can eat return of my capital. So I think that's a
right.
really important distinction that you're talking about. At the end of the day, though, you're still buying into companies, you're buying corporations, they still have to do well. So are these corporations in Canada, in the United States? What sectors are they in?
Yeah, I'm going to correct you. We don't need them to do well. We love mediocrity, okay, in terms of that stuff. So we just need them to plod along, right? That's why I'm a credit jock, right? I mean, I never was in the equity business. I was always a lender because what we want is mediocrity. We want we want companies that have limited growth, stable, relatively, bland profitability. Because what happens is when you have excess growth or excess profitability, there's this thing called competition that comes in, right? Capital is attracted. And so you kind of look at that going, so, we are on the hunt for mediocrity, right? And God knows there's lots of it. So we're in a good market, in that regard. So it's like, at the end of the day, you're really, it's stability, to your point. But that's the point of analysis, Catherine. And I'll get just a smidge of granularity here. And that is that there's been leverage creep over the last decade, which simply means that what we talk about leverage is it's the amount of first lien debt to an EBITDA number, right, in that regard. And, the market is certainly north of 6 times that number, which is too high for us. A portfolio that we're running is half of that. So we're very, very focused on making sure that the leverage of these companies is minimal. Cash is good, liquidity is good, and you have the consistency of the product or the service. Almost everything that we're doing is everything is US dollar, US domicile. We have some Canadian holdings from the company's perspective, and you think about the standard issues, and that is that the one thing that America has is healthcare, right? In that regard. And that's our biggest industry as a percent of GDP. I think it's almost 20%. So when you look at pharma, you look at bio, you look at devices, you look at services, it's a massive business, right? And so it's also quite protected from a recession, right? In that regard. So that's good. You have foods, you have consumer essentials, the way we view it, right? In that regard. So it's a massive, massive market. We're not much on the technology front. We're not certainly not much in, we're users of AI, but I'm not investors in it.
So just to be clear, because I don't think I heard it correctly, is there a percentage of Canadian companies that are in your fund? And like, look, I do have Canadian investments, but the whole elbows up, and I love the fact that you write elbows down. I mean, the United States accounts for 45% of our GDP and 70% of our trade. I mean, elbows down. Let's figure this out.
Well, you and I are on the same page here, and I think most people just some common sense, which isn't too common these days. It's simple, right? At the end of the day, and regardless of the vitriol and the diatribes in the comments, you just said it, right? I mean, Canada exists because the U.S. is the neighbor. You get to ship stuff down to America, and you have a standard of living and quality of life that exists because of that. And the notion that, now you're going to go do trade deals with, this guy, that guy, what do we have to trade in Canada, right? And then the idea is that energy, without a doubt, right? I mean, isn't it ironic? We saw a German deal coming out. It's like, didn't we tell them to go pound sand, like, a few years ago? So outside of energy, maybe a little bit on the ag side, again, there isn't anything that, America can't do. And if you look at the energy businesses of the future, I think somebody put it perfectly. When you look at technology, when you look at AI instruments, if you look at these things that are going on, as they said, Canada's still in the locker room, right? In that regard. So it's like, at the end of the day, don't you want to invest in the most robust growing economy?
Yeah.
And the answer is, yeah, you do.
We
So for us, 95% of our loans are U.S. domiciled companies.
Okay, Tim, great to be with you. Thank you.
Thanks, Catherine.